The IRS recently announced the new tax brackets for 2025. And all 7 tax brackets received minor increases to taxable income due to inflation. The jumps were not as significant as last year because inflation wasn't nearly as high. But the savings still add up to our federal taxes, our capital gains, and our qualified dividends. I've always liked diving deep into this nerdy tax stuff since my accounting days in college. But I'll try to keep this video focused on the heavy hitters that are the most impactful for your taxes. In this video, we'll cover the new 2025 federal tax tables, and we'll also jump into a detailed example that I think will be very helpful for anyone out there on how you can take advantage and pay fewer or no taxes with long-term capital gains and qualified dividends. Our tax system really is simpler than people realize. Pay attention to this one and you'll have everything you need to one-up Uncle Sam in 2025 and beyond. Putting together a game plan early for this tax stuff will save you a lot of money compared to shooting from the hip come the end of the year. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please Legion of Boom that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to mind. We had 2 new channel members this week. A huge shout out to Paulette and Johan. I appreciate you 2 joining the channel memberships, and I appreciate all of you that have been here all along. You 2, along with all of you veterans out there, are making this possible. You know what time it is. Let's grow. The U.S. Progressive Tax System. The U.S. has a progressive tax system, and this means that every taxpayer will pay the same amount of taxes in each bracket. Let's quickly clear up the most common misconceptions of our tax system before we dive deeper into the video. And this is the whole progressive part. I've had countless people tell me that they got screwed towards the end of the year when they earned a bonus or something that pushed them into that next tax bracket. They think all of their taxable income will be taxed at that new marginal rate, which is the highest bracket that their last dollar falls into. Now, as many know, the truth is they'll only pay that new higher tax rate from the new bracket they entered into with those few dollars that pushed them there. Everything below that amount will be taxed the exact same as if they never earned that bonus. A person that makes $1 million a year will be taxed the exact same on their first $57,000 earned as the person that only makes $57,000 for the entire year. We all benefit from the lower tax rates of each bracket on the way up. We'll dive deeper into a specific example here in a bit, but that's just the most important high-level concept to understand. The IRS adjusts the income thresholds of each tax bracket on a yearly basis for inflation to avoid bracket creep. And this is basically when someone gets pushed into a higher tax bracket just because of inflation. You know, their salary slowly goes up even if they get small raises. You have to have the tax brackets also slowly going up to make it comparatively the same. Let's dive into the changes coming our way next year. 2025 federal tax tables. The IRS increased the taxable income limit of each tax bracket by about 2.8% for 2025. This fell well short of the 5.4% increase that we got for each tax bracket last year, but it makes sense because of the tame level of inflation by comparison. Let's hop over to my screen to see what these new tax brackets look like for 2025. I broke this spreadsheet into the 2 most common type of filers, and that is single filers and married filing jointly. And you can see I left last year's information here as well. I have 2024 on both these tables, and I put the new amounts here for 2025 to the right, and then we can see the change. Okay, so there are 7 tax brackets as we discussed earlier, and they range from 10 to 37%. Most of us live in the 12 to 24% range, but there's of course outliers on both sides. The tax rates for each bracket remain the same in 2025. If the tax rate cuts do not get extended sometime this year, then a lot of these percentages will go up. 10 stays the same. I think 12 goes to 15. This goes to 25, I believe, 28. They all jump by a varied amount, but all of these will go up, and this will be 39.6%. As of right now for 2025, these are still the rates. And here in the single filers, we can see that the 10% bracket used to end at 11,600. It now goes to 11,925. That's up 2.8%. The 12% bracket goes up to $48,475. The 22% bracket goes up to $103,350. Anything over that goes to 24%, which goes up to $197,300. 32% goes up to $250,525. 35%, the second to last one, goes up to $626,000. And then anything over that taxable income amount, the rest is at 37%. That's the top tax bracket. And you can see, I wasn't gonna go over each one, but the percentages are around 2.8 each time. Thankfully for my OCD, they do round the numbers, so they're not exactly 2.8, and I appreciate that. And then the married filing jointly, which is where I do most of my examples. Frankly, it's me, and it's a lot of people I know. I know there's lots of single people too out there, but these are the numbers I usually refer to in my videos in general. You can see that the 10% now ends at $23,850, and these are all up about 2.8% as well. 12%, this is a huge one, and we'll talk about why that's the case here in a bit, is $96,950. And then 22% is up to $206,700. 24% is up to $394,600. 32% is $501,000. 35% is up to $751,600. And then anything above that for married filing jointly is taxed at 37%. So the new tax brackets to reflect inflation went up about 2.8%, not too shabby. And before we move on, I wanted to show a quick example of the progressive nature of our taxes. And this is an example from 2024, but it's just showing that if you had $50,000 of taxable income as a single filer, you would pay the following taxes. And we'll just go down to the visual. It's probably easier to see here. So your taxable income is $50,000, and this could be $1 million. It doesn't matter because the first 11.6K is taxed at 10% for everybody. And then the next, between this amount and up to $47,150 is taxed at 12% for everybody. And then only that 3,000, that 2,850 is taxed at the 22%. So there's no such thing as pushing yourself into the next bracket and screwing up the stuff retroactively. It's all progressive for every tax filer for each tax bracket. It's time to dive into the most important tax concept for those of you looking to compound serious wealth. 2025 capital gains and qualified dividends. Capital gains and qualified dividends have a special tax table that is taxed more favorably compared to your ordinary income. A capital gains tax is the tax on the profit from when you sell an asset. This can include investments such as stocks, bonds, cryptocurrency, real estate, cars, boats, and other tangible items. Now, there are long and short-term capital gains when you sell an asset, and you only get the special tax table, that tax advantage for long-term capital gains. Long-term capital gains apply if you held the asset for more than a year before flipping it for a profit. And short-term capital gains apply if you held that asset for under 1 year before selling it. And they'll be taxed at your marginal tax rate, so it's as if you had more ordinary income. So generally speaking, you want to hold on to an asset for over a year before selling it for a profit. Your long-term capital gains and your qualified dividends will be taxed at either 0, 15, or 20%, and it can be a mixture of those, and we'll get into that in the example to come, depending on your taxable income. Let's hop over my screen and check out the capital gains tables for 2025. We're going to cover this one pretty quick because I am going to show a detailed example that should resonate for most people with ordinary income and capital gains and qualified dividends. So these are the special tax tables for the long-term capital gains and the qualified dividends. And you can see there's only 3 brackets. We have single filers up top and married filing jointly right here. They went up by the 2.8%, that same amount as the normal federal tax tables. So everything went up about 2.8% this year. And you can see the 2025 limits. If you're filing single, is anything under $48,350 of taxable income is taxed at 0% for these qualified gains. And then anything up to $533,400 will be taxed at 15%. And anything above that $533,000 will be taxed at 20%. Remember, this is before the standard deduction, so it's even better than this in reality. You have even higher limits when you really work out the math, and we'll get there. And then the married filing jointly, you can see anything under $90,000 $96,700 is taxed at that juicy 0%. Again, with the standard deduction, you can add $30K to this. And then anything under $600,000 is taxed at 15%. And then for you high earners out there over $600,000 of taxable income, it would be taxed at 20%. And these align with the 10 and 12% bracket, 22, 24, and maybe 32, I'm not sure, and then 35 and 37. So these are all significantly more favorable than the same income amount federal tax tables. Okay, this one is very important. This is something that every investor, every person really needs to know, especially retirees. Long-term capital gains and qualified dividends will not, I repeat, they will not push you to a higher federal income tax bracket. They are considered after and separately from your ordinary income that is used to establish your marginal tax rate. The taxable amount from your ordinary income will affect how we apply the capital gains and the qualified dividends to the special tax table. Let me just show you an example because I'm sure this is as clear as mud at this point. Okay, this looks scary. Please don't run away. This is very basic. I just broke it into all the steps and we're going to walk through this line by line. Here is the person in question's earnings and they are married filing jointly. Okay, so we'll cover all this. So they had a combined work income of $90,000. And that could also, if you were retired, a pension would also be ordinary income. A lot of your Social Security is oftentimes taxed, 85% for a lot of people, but that would be here. Now there's zeros in this scenario because this person's still working, but I just wanted to make the point, this is the same type of income. It's all ordinary. Non-qualified dividends from REITs and covered call ETFs and things like that. And they had $10,000. And then short-term capital gains held it for less than a year. They had $6,000. So their total ordinary income was $106,000, okay? And remember, we do all these calculations before we even consider qualified income. This is tacked on at the end and completely separate. So let's continue the walkthrough. We have $106,000 of ordinary income, and then the standard deduction this year for married filing jointly is $30,000 if you're under 65. You add a couple thousand, I believe, $1,600 or something like that if you're over 65. And for single, it's $15,000, but we're going to keep rolling with this example. So the taxable income so far is $76,000. That's our ordinary income, which rolled to here, minus the standard deduction. So that $76,000 puts you in the 10 and 12% tax bracket. I copied them. We already checked these out. This is just a screenshot here. I can't even click the cells, but you can see here, married filing jointly for the federal tax tables, the first $23,850 was taxed at 10%, and I reflect that here. And there's your tax amount. And then beyond the 23.8K, but before 96, which is the rest in this situation, is taxed at 12%. So 52,000 was taxed at 12%. You add those together, and that's your $76,000 of taxable income. So your total federal taxes paid would be $8,643. So this part up here is done, and your marginal tax rate of 12% is set in stone. It will not change. We're going to come down to the qualified income, but even if this was $1 million, your 12% would not change. It's over and done. So on your qualified income, we had $25,000 of qualified dividends from our juicy SCHDs and DGROs and VOOs and all those types of ETFs. And long-term capital gains, profits on those assets we held over a year, usually stocks or ETFs, $50,000. So we had $75,000 of qualified income, qualified dividends, and long-term capital gains. Now, this $76,000 of taxable income that we used up here does drop down to here to create our total taxable income. Okay, so we have $151,000 of total taxable income. Now, the reason that's important, we're done paying taxes on it, but this income counts towards the thresholds of the special tax table for long-term capital gains. So you can see anything under $96,700 is taxed at 0%. So in this case, we have $20,700 $2,700 taxed at 0%. And that's because we had the $76,000 of taxable income. And if you add $20,700 to it, it hits that threshold of $96.7K. So that's taxed, that's $0 of tax. Now, anything over that, which for us happens to be $54,300 of these qualified dividends and long-term capital gains, will be taxed at 15%. And that's because our taxable income hit the next threshold. So we're in the 15% tax range, and that's $81.45 of taxes. And you might be thinking, 15%? That's more than our marginal rate of 12%. I thought these were good. But remember, we already had this income. If this was ordinary income, it would have pushed us into the 22% tax bracket. Anything over 96,950, you're done with the 12, so that would be at 22. So instead of 0, it would have filled up the rest, the 12, and instead of 15, it would have started to fill up the 22% bracket. So these are always better, except for the weird little amount, which drives me crazy. I wish they'd make them the exact same. But even though this tax rate is higher, don't let it fool you. It would have been even higher if it was ordinary income, short-term capital gains, things like that. That's why you want to hold on to these assets. And this isn't even that extreme of an example. The overarching point of this spiel is to always do the federal stuff up here first and separately. Your taxes are paid up here, and you have established your marginal tax rate, and that's what it is. And then you do this tack on information. But I wanted to show how this number here does drop down to affect this, but this is still favorable. Oh, and one last thing I wanted to remind people. If you were retired and so you had zero work income, you didn't have a pension, that's like me, my wife and I will not have a pension someday, and you were before Social Security, you didn't have any non-qualified dividends, and you didn't have any short-term capital gains. So this could be 0, and that would leave you with qualified income if you had built up your portfolio and you were reaping the benefits, you know, whether you're selling positions for long-term capital gains or getting those qualified dividends. This could be up to $96,700 plus the $30,000 standard deduction. So you could actually make $126,700 and pay $0 on taxes. You heard that right. You can make $126,000 and pay zilch when you file. Short-term capital gains are considered ordinary income, and they can also push you to a higher marginal tax rate. I said it earlier in the video, but it really is important, especially as you start earning more money and you have more assets that you're flipping here and there, to hold on to things for at least a year when it makes sense. I mean, there is such thing as getting rid of bad assets, but for the most part, you really do want to hold it for a year, because it's not just the lower tax rate from the special tax table. There's also a lot of trickle-down effects of what it does to your other taxable income. It makes a huge impact. And there's so much more to learn about taxes. It really is my favorite subject in accounting, and I would love to say that I'm joking about that, but I'm not. Yes, I know it's really sad, but let's cover a few other key concepts. Other important tax tips. Another important tax tip is to know that you can exclude up to $250,000 if you're single, or $500,000 if you're married when you sell your primary residence. There are a few criteria that must be met. You must have lived there for at least 2 of the last 5 years, and you must not have excluded another primary residence from capital gains in a 2-year period before the home sale. And again, it must be your primary residence, so you can't use this if you're selling your second home or your vacation home that you live at less than half the time. Another important tool for the toolbox is offsetting capital gains with capital losses. And a quick example of this one is, let's say you bought $5,000 worth of stock A and $5,000 worth of stock B. And down the road, you sell stock A for $10,000 with a nice profit of $5,000 on that one. And you sell stock B for $2,000, a loss of $3,000 on that one. Your total capital gain is offset to $2,000. You can basically write off that $3,000 loss against the $5,000 profit. And now it's important to know that short-term capital gains will first offset against short-term capital losses, and long-term capital gains will offset first against long-term capital losses. But then an excess of either type will be netted against each other. You are only allowed to offset your ordinary income by $3,000 of capital losses each year. That amount feels comically low at this point, but it's what we have to work with. I guess just don't lose money? There is a lot more going on with taxes, but these basic tips will get you 95% of the way there for your planning as you invest over the years and build your wealth. Because I love this tax stuff so much, I'll be dropping a video in the coming months regarding Roth conversions and 72T early withdrawals from your 401k, penalty free. So stay tuned for those ones. And check out one of these 2 videos if you want to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I'll see you in the next one. Peace!